What's going on? Alex here, and today I'm answering your tax questions from Reddit. And today's question has to do with the treatment of a business expense for which you later get a refund. How do you handle that? Let's take a look. All right, so this question comes from Will Anderson 419 and goes as follows. Purchased item written off as business expense, then refunded. So I own an LLC and I'm looking to purchase various pieces of electronic equipment over the next few months. I'm planning on investing all of my company's revenue this year back into business expenses, so my profit would effectively be zero. Let's say I purchase a MacBook Pro on April 10th and file it as a business expense. I would then deduct that from my income/profit for the year per usual. Then, let's say I file my taxes on April 15th but decide to return the MacBook Pro on April 20th. Would the refund count as income for the next year? How would I mark that for tax purposes? With regard to the purchase of a MacBook Pro, the first question you have to ask yourself is whether it's a legitimate business expense in that you're using it 100% for business purposes. If you're buying this computer to use 30% for business purposes, you need to make an adjustment there. So right up front, a bit of an analysis to determine the proper tax treatment for this item. And of course, with any business expenses, they have to be ordinary and necessary. So assuming we jump over those hurdles, then the next question is, how do we treat the business expense and the subsequent refund? If you purchase the MacBook Pro on April 10th, and then you file your taxes on April 15th and choose to return the MacBook Pro on April 20th, the first issue is that essentially, if all of this happened in tax year 2020, you're only dealing in tax year 2020. The April 15th filing deadline has nothing to do with a cutoff as to where business expenses and refunds really have an impact on anything. If you're a calendar year taxpayer, then the cutoff is December 31st of a particular year. So in that case, this transaction would be a wash. So if you purchased the MacBook on April 10th, you return on April 20th, essentially nothing has happened, right? So if you get a refund of the full amount, then there's really no income, no expense. It zeroes out. If there's some kind of restocking fee, then that can constitute an expense for your business. But other than that, there's really no effect here. But I know what you're getting at. You're asking about a situation where, let's say you purchase an asset in November of a particular tax year, and then you return it in January of the next year. What is the impact in that situation, right? Because you would have taken the deduction in year one, let's call it, in the year of purchase and the year that you placed it into service. And then in the subsequent tax year, you get a refund. How do you treat that? So essentially, in year one, you're going to take the deduction, assuming all of the requirements are met to actually deduct it. And it's going to create a tax benefit for you. So we're not taking into account suspended losses, passive loss rules, all those different things. We're assuming that the deduction created a tax benefit for you in year one. Then in year two, when you receive the refund because you returned the item, you would then record that amount as income. The amount of the refund you would take as income for business purposes. So in year one, you received a deduction in the year in which you purchased and placed it into service. In year two, you got a refund. You would take that into account as income. And you see it evens out when all is said and done. Of course, it transfers some of the income taxes arguably from one year to the next, but really it comes out to be a wash when all is said and done. The marginal tax rates don't change all that much to really make a difference in that respect. But that's how you take it into account. So if you purchase an item in 1 year and then you receive a refund in the next year, then there's essentially a deduction if it qualifies for a deduction in year one, and then it's recognized in income in year two. This is all based, if you want to read more on this, on the tax benefit rule. And this can get a lot more complex if you, let's say, have suspended losses, passive loss rules are in effect for whatever reason, then that can complicate matters. But in this scenario, that is the default treatment unless there's other issues at play. So, Will Anderson, hopefully this adds some color to your question and some clarity in terms of this crazy world of taxes. Now, if you found this video helpful, feel free to leave a comment, like the video, subscribe to the channel, and make sure to hit that bell icon to be notified of future videos because there will be more. With that said, hopefully this was helpful. Thanks for watching.